Is ContextLogic, aka Wish, an investable idea? Let's cover the bull and the bear case for owning this stock quickly. My name is Brian Feroldi.
And my name is Brian Stoffel.
We recently ran Wish, ContextLogic, through our investing framework, and we want to give you an overview of our thoughts about this company. Brian, for those that don't know, like us, we'd never heard of this business before. What do?
Yeah, given their size, it's kind of surprising we didn't. But so they have an app. But what that app does, what that business does, is it creates a two-sided network. And so what they do is they've got 550 merchants that are putting their goods up on this marketplace app. When I say marketplace app, not that different than listing your goods on Amazon or eBay. And they've got over 100 million monthly active users who are going to that app and looking for things to buy. And it's worth saying that they are really focused on low cost goods. You've made two great analogies. It's either like the dollar store of e-commerce, or you could even say the Spirit Airlines of e-commerce. They are focused on the low price, as low as you can get.
They source goods from all over the world. They really got their start in China, and they list goods on Wish, their app, for extremely low prices. In exchange for those low prices, you basically agree to get shipping in weeks, or in some cases in a matter of days. But they've done a great job of building out both the merchant side of the business as well as the user side of the business. And this is a very popular app. And they're targeting users that make less than $75,000 per year, which they say is a segment of the market that's been ignored by e-commerce.
Right. And so what do you get if you're a merchant and you put up? Well, you get data, and that data is important. You get demand generation, which basically just means you have access to those 100 million monthly active users. There are some really important other things you get, like logistics. Now, they don't have a fulfillment network, but their software allows you to connect with the first and the last mile providers for delivering products. Cross-border, which is really important because a lot of their merchants are in China, but a lot of their customers are in Europe and North America, and also business operations. So it gives you a backbone for a lot of your back office operations.
Yeah, it's an important tool that helps. And they call out in their delivery that they are focused on both the users of their app as well as the merchants of their app. They consider both of those groups to be their customers. I think that's important to point out. And to your point, they have built out a pretty extensive delivery network that handles that partners with logistics companies to make sure that everything that the merchant needs to get the product to the user is taken care of.
Right, and it's just worth again pointing out these aren't Wish trucks, and they are not Wish fulfillment centers, but they have connections. You can basically plug in the software and it can take care of itself, which is very convenient. Now, they've also expanded into Wish Local, which basically just means, Brian, you're in Rhode Island, I'm in Wisconsin, and if we go on Wish and we want to buy something local, it'll give us merchants that are within a certain number of miles away from where we're coming from.
And that's a key feature for the stores themselves, because they can say, use our app, and that brings those users into the store. So it's kind of almost like an offer buy online, pick up in store functionality, which is something that a lot of small merchants can't necessarily do. So that could be a key advantage for this company. And I like that this feature was launched in 2019, essentially 2 years ago, and it's already responsible for 8% of their revenue.
Yeah. I think it's a great sign of optionality.
For sure. Now, if you look at their revenue split out, this company, it makes money both in Europe, North America, as well as the rest of the world. So this is not just a North American story by a long shot. In fact, their biggest market is Europe. And I also like that they have 3 different reportable segments for revenue. Core marketplace, which is their legacy traditional Wish business. Logistics, which is those services that they provide to get you the goods. And then Product Boost, which is their marketing program. And they really call out that their logistics business is really on fire and growing rapidly.
And since it's just software, it's relatively high margin. It's a much higher margin than running a fulfillment network and much lower cost.
Yeah. One other thing they point out is that they've done a good job with keeping the buyers that they have and convincing them to spend more over time. So this cohort analysis shows if you're an active buyer in, say, 2016, you consistently spent more on Wish over time. Now, this doesn't include buyers that left the platform. These are just active buyers, but it does show that they are getting some loyalty from their existing user base. And it's a great model when you can attract new customers while convincing existing ones to spend more.
Yeah, especially because they're spending so much to get those users in.
Yeah, and we'll get to that. So what's the bull case for this company? Well, first off, both of us love that this was a founder-led company that is really focused on its mission, which is to make affordable and entertaining mobile shopping experience. And they hammered that home in all of their materials on their website, on their Glassdoor page, on their 10K. Really kudos to them for really sticking to that mission. Two, this is a differentiated shopping experience. Again, it's like Spirit Airlines for e-commerce, or it's like a dollar store for e-commerce. They are hyper-focused on price, and they sacrifice basically everything else. That is attractive to a certain subset of shoppers. Three, we both really like that the company has clear signs of optionality. The Wish Local business didn't exist 2 years ago, and now it's growing quickly. I also like that they're getting into the logistics game. Finally, the market for these goods is just enormous. Global e-commerce sales are growing rapidly and are measured in the trillions of dollars. So if this business does not succeed, it's not because the opportunity isn't there.
Yep. But it's really important to talk about the bear case. And the first is the one I just talked about, the cost to acquire users. Historically, the company is spending more on sales and marketing than it brings in gross profit. And so that just tells you that's how much they have to spend to bring in those new customers. Obviously, if this is going to be a sustainable company, but also a winning investment, they need to be able to spend a much smaller percentage of their gross profit on sales and marketing. Because of that, the company is not profitable. It's not free cash flow positive. Now, if they turn, to your point that you've made before, if they turned their sales and marketing engine off, they could swing to this quickly, but they don't want that because they need more people to know about this in order to continue growing and going after that market. Now, the company had low Glassdoor ratings. They weren't the worst ever, but the company is headquartered in Silicon Valley, and you don't want low employee Glassdoor ratings there because you've got so many companies, Zoom, Apple, that are based there that are offering a much better deal and a much more positive experience. So we weren't too happy to see that. And kind of along the same lines, it also raised a yellow flag that the chief financial officer resigned and the company just went public in December. So roughly 6 months after going public, the CFO resigning without a replacement kind of set in place. So that seems like this was more abrupt. That doesn't mean that there's something nefarious going on, but it's also not a great sign.
Yeah. Could that be related to the low Glassdoor ratings? Is this a tough place to work? Hard to say as an outsider, but that did not sit well with either of us. So how did it score on our investing checklists? For me, this company got a 61. And the biggest knocks against it was that it wasn't yet profitable. It wasn't free cash flow positive. Its stock has underperformed the market since coming public. And it has missed several of Wall Street's its first 2 earnings reports as a public company. Those things knocked down its number significantly. If the stock can become profitable, start beating the market, and they start smashing Wall Street's expectations, this score could improve in a hurry. But for me, for right now, as of July of 2021, this company is not investable, according to my checklist. How did it do on yours?
Pretty much the same. A 6.5 is in the fragile rating for me. If they were to become free cash flow positive to a significant extent, it could enter that yellow robust area. But we always say, Brian, that what you find out in the process of doing these frameworks is more important than the score itself. The biggest thing to me is that I just don't know how strong this moat is. Are the network effects that strong? Are the switching costs that high for merchants? The only thing that can prove that to me is consistency. And so I'm going to need to see consistency. And that leads us right into what we need to watch going forward.
Number one, you just called it out. How wide is this moat really? Are customers that find this app, are they really loyal and stick with it for a long period of time? Or is this company going to have to shell out marketing dollar after marketing dollar to get people to remember their platform? It's a competitive market they're in. They're up against tech titans, tech giants. When you say e-commerce, I immediately think Amazon. If I was to think of a number 2, it would be Shopify. So they're really going to have to spend big to get me to not think of those companies. So that's the thing to watch.
Next, they really got to lower those marketing costs because, as we've already called it out, but it cannot be said enough that they need to prove that they've got a valuable brand. And the way that you have a valuable brand is that you don't have to spend as much to get people into your ecosystem. We talk about Tesla all the time, the fact that they're one of the most popular companies and car brands in the world, and they spend nothing on marketing. And that's a huge advantage. That's something that Wish needs to get going for them. It'll never reach that point, but it needs to get to a sustainable point.
Number 3 is going to be the culture. Are there going to be other CEO departures? Is the Glassdoor ratings going to improve? That's a big red mark on this company right now. And then finally, profits. Can this company get to profitability? Importantly, they're spending so much on marketing and sales costs that they could be profitable today if they wanted to. They're choosing to forgo that in order to invest, and they have the balance sheet to do so. But that's going to be a major thing that catalyzes this company from a 60 on my score to a much higher score over time. Well, thank you. We hope that you enjoyed that. Brian and I really liked researching this stock. If you want to watch the full research video that we did on ContextLogic to get even more information, click the link right here. Brian, see you next time.
See you next week.